Hello, everyone, and welcome back to the Female Property Expert Podcast. I'm Emma Morby, and today we're going to be covering a topic that is often kind of overlooked in the property world, but it is a really key, essential part for long-term success. And this is going to be exit strategies. So when it comes to property investing, we often focus on the acquiring the property, expanding our portfolios, maximizing our returns. But knowing when and how to exit a deal can be just as important. So a well-planned exit strategy does allow you to lock in profits, for instance. It can free up capital, and it can even protect yourself from changing market conditions. So in today's episode, we are going to go over the different exit strategies that you, as a property investor, are likely to encounter and you can use to get the most out of your investments. So we're going to be covering selling, refinancing, rental options, and diversifying into sort of different property sectors. I'm going to break down each option as we go. And it's going to be how to decide on the right timing and examples that are relevant to the UK market. Hopefully, by the end of this episode, you will have a clearer picture of how to approach exiting your investments, whether you're looking for quick capital gains or a steady income. So if you're ready, grab yourself a cup of tea, glass of wine, whenever you're listening to this. If you're sat on the train, earpods in, let's get started. So let me cover the importance of why an exit strategy is so critical. Now, many investors, especially those who are new to property, get caught up in all that excitement of the acquisitions and the growth phase. But knowing your exit options before you even purchase a property gives you a huge advantage. So first of all, the property market, like any market, is subject to change. We've seen this especially over the last 18 months. A good exit strategy acts as like a safety net in case things don't go as planned. For instance, if property values in your area start to decline, having a plan to sell or refinance means you can react before it starts to impact your bottom line. The other thing is timing your exit. Timing your exit can greatly influence your profits. For example, in the UK, this is, if you're holding a property that's appreciated significantly over the past few years, it might be an ideal time to cash in on that growth before any market shifts. So we're in a decline at the moment. So if you cash in on some of those, remortgage them or refinance them, take some money out, you'll be in a position to buy when the market is low. And as it climbs back up again, obviously you'll have an increased portfolio in size, but also wealth. And the last one really is reinvesting opportunity. So a well-timed exit, like I said, will free up your capital. It's going to allow you to reinvest into other properties or different sectors or whatever you want, but it gives you the ability to have that cash to be able to play with. So as an example, if you bought a flat in London 5 years ago, its value has now doubled. Selling now could provide you with funds to kind of multiply, to buy multiple properties in higher yielding areas. And this is probably likely to be up north, like Manchester or Leeds, places like that. So before you acquire a property, think about how your exit strategy is. Are you in it for long haul? Are you hoping for a steady rental income? Or are you looking for a quick capital gains, i.e. buy it and flip it? Your strategy is going to help you shape not only your approach to buying, but it'll also help you manage that property in years to follow. So you'll understand, actually, this is going to be a 5-year cycle because I want to exit, in 5 years with X amount of pounds. So let's start with the most straightforward exit strategy, selling. Selling is the most straightforward strategy. Selling allows you to realize gains from appreciation and walk away basically with cash in your hand, which can then be reinvested or used to achieve sort of personal financial growth or goals or whatever you have. But timing and strategy is crucial so you maximize your returns. So let's look at timing the market. In the UK, property cycles tend to be obviously have their ups and downs. For instance, we've seen a significant price growth in certain regions due to demand, particularly London and the southeast of England. However, some of this growth slowed in recent years, while regions like the northwest are experiencing an uptick in trend. So if you've been holding on property in an area where prices are peaking right now, it might be a good time to consider selling. Then you have the capital gains tax. Don't forget to account for capital gains tax when selling a property in the UK. For most buy-to-let properties, you'll pay capital gains on the profit made from the sale. It's often beneficial to consult a tax advisor at this stage to understand what your liabilities and plan your sale around the capital gains relief, or any capital gains tax relief, should I say. And then you have preparing the property for sale. So maximizing sale prices basically involves preparing the property for the market. Small improvements, fresh coat of paint, staging, i.e. furniture, making it feel homely. Professional photos will make all the difference. Here's an example. A client of mine once spent £1,500 on touch-ups and ended up getting offers of over 10,000 from their initial expected price. So it went £10,000 over asking price, all from touch-ups, and I think they actually put a new bathroom in as well. But that's it, just a plain bog standard bathroom suite and some paintwork. So for the sake of £1,500, they've made an extra £10,000 and they got the asking price plus £10,000. Selling is a great option if you want a clean break or if you need a lump sum of cash. It works well for investors who've seen sort of significant appreciation and want to take profits out without the hassle of, kind of property management. And we'll sometimes see this when people buy and sell, buy and sell, buy and sell. The other exit strategy you've got is refinancing the property. So refinancing is another very powerful exit strategy that allows you to extract equity, i.e. profit, from a property while still retaining it. So this exit strategy is particularly effective if the property has appreciated or if it's added value through renovations, for instance, and there is money sat in there doing nothing. So when should you consider refinancing? Refinancing works best when your property's value has risen since you purchased it. For instance, if you bought a flat in Birmingham and it was £200,000 and it's now worth £300,000, you could refinance to release a proportion of that increased equity. Typically, you're going to be around about 75% loan to value. Obviously, that's subject to lender's approval, but that would be roughly where your refinance would sit. The benefits of refinancing? The primary benefit is that you gain access to a lump sum without selling. So this money can be reinvested into new properties, allowing you to grow your portfolio. This strategy enables you to do what we call leverage in the industry, where you're essentially using property's value to fund further growth. And leverage is really key as long as you do it safely. Moving on from safely, there are risks and considerations that you have to do. So be mindful of increased monthly payments if you refinance. Find out what they are and also what the refinance package is. What does it lock you into? You need to work out what the interest rate will be and the impact on your profitability. So I would always suggest shopping around for competitive rates or go to a mortgage broker who specializes in refinancing, and they can go to the whole of the market and get you the best deal. There are websites like Money Supermarket, or Which is another one, which give mortgage advice. Great resources for comparing mortgage rates in the UK. If I'm honest, you can take it with a pinch of salt because by the time you've spoken to the mortgage provider and they've added their fees in, etc., it is a little bit more than what it looks like. They always seem to put their most competitive rate out. And in reality, unless you tick every box, you're not going to get that. But it's worth having a look so you understand where the market is placed. And refinancing is perfect if you want to expand your portfolio or reinvest without giving up the income or capital growth potential of that particular property or properties that you own. Another exit strategy is converting to a long-term rental or a short-term rental. Now, we saw a lot of this during COVID, a lot. So effectively, you can convert your property into a long-term rental or short-term rental. This approach allows you to generate a consistent income. It makes it ideal for investors seeking regular cash flow rather than kind of immediate lump sum buy and sell. So let's look at the long-term rentals. With long-term rentals, you lease the property for a year or longer to a tenant. Now, this provides a stable, predictable income. In the UK, certain cities such as Manchester, Liverpool, Leeds currently have really high rental demand due to their growing economies and the influx of young professionals. If you hold properties in these areas, converting to a long-term rental can provide reliable monthly income, for instance. Then you have the short-term rentals. Most of these are holiday lets or corporate lets. So if your property is in a tourist location, like maybe Cornwall or the Lake District, or if it's in London or Birmingham, for instance, you might want to have a corporate let system in place. Short-term rentals can be very lucrative. Platforms like Airbnb and Booking.com allow you to rent out property to tourists or travelers, often at a much higher rate than traditional rents because you're doing it on a night-by-night basis, as opposed to just a monthly amount every month to a single family, for instance. Now, I talk about all of these things. If you want to learn about any of this, we do have a program you can join, and it will teach you about all of the long-term rentals, short-term rentals, and how you do it and go into great detail. But I'm just covering off the sort of the top end at the moment so you understand the different exit strategies. And finally, there's legal and management considerations for long or short-term rentals. So for long-term rentals, you need to familiarize yourself with the UK rental regulations, like the requirement for an EPC, which is an energy performance certificate, the rating of, it used to be E, it's now gone to D or above, unless there's special criteria. It's actually climbed to, or it is climbing to C. Might have already done it by the time you're listening to this podcast. And there are mandatory safety checks as well, such as smoke and carbon monoxide alarms, gas safety checks, electrical certificates, those sorts of things. Now, for short-term lets, you need to be aware that some councils have restrictions on short-term rentals, particularly in London. There's a 90-day restriction. Also, you need to be aware that sometimes in certain areas, you're going to require planning permission, or you're going to need to change the use class of that property. If it's currently C3, it's going to need to go into a short-term holiday let, for instance. You're going to then change the use class from C3 into the holiday let use class. Now, also, a property management company can be helpful in this situation for both options if you prefer a hands-off approach. So whether you're doing short-term or long-term, you don't necessarily have to be involved in the day-to-day unless you want to be, but you are going to pay for that. So you need to factor that into all of your budgeting. And it's normally between 10 and 20% on both short and long-term rentals. But by converting to a rental property, in theory, you keep ownership of that property, benefiting from any sort of property appreciation, so any increase in value. And it also generates an ongoing income for you. So it's ideal, really, for those who are looking to supplement their monthly income while still building their wealth pot up. And the last exit strategy I want to talk to you about is diversifying into other property sectors. So let's talk about the different sectors. So this approach for me is about reallocating capital from residential to commercial properties, HMOs, so houses of multiple occupation, or other types of commercial investment. And this allows you to optimize your returns or balance your portfolio so you spread your risk. So firstly, you have commercial properties like office space or retail units. Okay. Often these offer long-term or longer-term leases and potentially higher yields compared to residential units. A client of ours or a student of ours once converted a residential property into a small office space. This investment was in the Midlands, where the sort of lease term they'd set up was for 5 years, and it was with the same tenant. So it provided a steady return without sort of frequent tenant turnover for 5 years, and all because it went from residential to office. Then we have the HMOs. Now, HMOs are properties rented to multiple tenants, such as student housing or co-living spaces. This strategy can be really lucrative, especially in university towns or cities or anywhere really with high demand for affordable shared accommodation. Now, you often see this in properties in Nottingham, Leicester, Sheffield, because these are where the ideal setup is. It's where a lot of the universities are. You see it in Oxford, for instance. There are restrictions in HMOs in Oxford, but you do see it in Oxford. However, I want you just to keep in mind that HMOs require special licensing and often come with much more management responsibilities. So consider that when you're looking at what you want to be, hands-on or hands-off. And lastly, I want to talk to you about the diversification benefits. The idea here is to spread your investments to reduce risk, basically. If one sector underperforms, which we saw in COVID, others in your portfolio might hold steady. So if you have a portfolio full of short-term rentals and then COVID hit, your business is dead overnight. But if you had a couple of long-term rentals and a couple of HMOs thrown in there, well, they're going to still carry on trading. The HMOs might be slightly harder because they did also close universities, but you could have then turned them into lets for co-living, for instance. Now, I kind of look at it as a way of hedging your bets, spreading your risk, not putting all your eggs in one basket within the property market itself is what I'm referring to. So if you're interested in diversifying, research property sectors that I think suit your risk tolerance and also your financial goals. You can find more information through RICS, the Royal Institute of Chartered Surveyors, or you can come to us and we will happily talk you through the different types of more frequent property sectors that are used and discuss any trends or opportunities. And as always, if you have any questions or you're unsure about anything, please feel free to reach out through social media to us, or you can drop an email if you want to join our program to support@thefemalepropertyexpert.co.uk. Now, that's a wrap for our episode on exit strategies. I hope you feel more confident in kind of planning your own property investment exits. Remember, having a strategy isn't just about when to get out, but also about maximizing the value of your actual investment itself, whether that means selling, refinancing, converting to rentals, or diversifying into different sectors. It all means that you're looking at your portfolio or you're looking at how your portfolio is going to grow and understanding the exit strategies needed. If you enjoyed today's episode and want more insights, make sure you comment below and I will come back to you as quickly as we can. Thank you for your time and happy investing.